No scrubbing, no time-consuming water blasting, no sweat.
An iconic Kiwi can-do brand
Wet and forget the original moss mould and gunge remover.
is now owned by
My friends do call me the godfather of private equity.
the godfather is Ross George. His company is Direct Capital and is celebrating 30 years of deal making.
That money flows back to superannuitants and to charities, and I just think that's a very nice form of capitalism.
He talks keeping secrets,
We have this information dissemination policy called Nothing, Nowhere, Never.
and what makes up that special investing formula. It's a bit like a dating game, really, with a lot of ramifications.
Do you know what? I think it's more than that. I think it's a marriage game.
Welcome to the NBR Podcast. I'm your host, Simon Shepherd. This week, as part of NBR's annual series on M&A activity over the last year, an interview with one of New Zealand's biggest deal makers. Ross George is the Managing Director of Direct Capital, a company he co-founded with mates Bill Commode and Mark Hutton. Over the past 30 years, the company has raised $1.7 billion to invest in Kiwi and Aussie companies. They include familiar names like Ryman Healthcare, Sky City, Max Fashions, Bailey's, Scales Corporation, and most recently, Wet and Forget. Would you call yourself the pioneer of private capital in New Zealand?
I don't call myself that, no, but but my friends do call me the godfather of private equity.
Really?
But I think it really came from it not existing in New Zealand at the time, and I had been doing it overseas. So it was really clear to me that there was a place for equity capital for private companies in New Zealand, and in fact the private companies were crying out for it.
So you brought the model back here.
Yes.
And found success straight away?
No, in fact, I came back in 1992 and thought about raising this fund, and it just wasn't the climate for it. So I took a couple of years. I took a year off or so, and a year of planning Direct Capital, and it was actually very good for me. It was. And it was very good because I met a lot of private company owners by that point who'd told me, yes, you can get money for this, but you have to pledge your house for it, or you have to put up personal security, a personal guarantee. So it strengthened, that 92 to 94 period when we did start, did strengthen my conviction about what we do here.
30 years on, you've raised $1.7 billion over that time. That's quite an eye-watering amount. Could you have ever envisaged that when you struck out in 94?
I don't know, you don't, when we were 32 and 33 when we started this, so you don't look a long way forward when you're starting. You're just trying to establish step number one with a good strategy to get to the other things. So it's pretty much, Mark and Bill and I were pretty much, shoulders to the wheel in the early days. But what we were always confident of is if we did a good job with the first fund, we would have another fund, and that's what happened. But no, I suppose you don't think like that. But nor do you think, nor do you know how quickly 30 years go, and nor do you think about year 30 when you're in year one.
No, most people don't. I guess if you could explain to me and to the layperson, where does the money come from?
Every 4 or 5 years we raise a fund. In fact, we're raising the 7th fund, Direct Capital 7, just proposing to start it shortly actually. And we approach primarily superannuation funds, and all around the world the superannuation funds are about 80% of the money that goes into private equity. And that's because you've got very long term, you've got people who are 30 investing in the funds, and so they don't need the liquidity to within a 10-year period. So it comes from superannuation funds, it comes from sort of large insurance companies, and including ACC, who have been with us from day one, I should add. That's 30 years of continuous investment.
Wow.
and we've treated each other well, and so we tend to get investors back for each of the funds. So it's also community trusts who are long-term groups.
Community trusts?
Yes.
Would they have the kind of money?
They do.
Do
There's
they?
very large ones actually, in the billions.
Wow.
Yes.
So we're not talking New Zealand community trusts.
Yes,
We are.
Yes.
See, that would be surprising to people, I think.
Yes. Yeah, groups like Foundation North are very large. Rata in Canterbury are very large.
Right.
Tauranga, if you include all of their community and utility trusts, are very large. So it's groups like that. It's religious trusts.
Yep.
Education trusts.
Okay.
Iwi. It's anyone with a long-term horizon.
Long-term horizon.
Because unbeknownst to, as you say, the lay person there, we invest and hold for a very long time. We get dividends and we distribute dividends to our investors. It's not offshore. This is very much buy a business, fix it up, and put quite a lot of debt in there,
Yep.
and then sell it. That's not the model in New Zealand.
That's not the model. That's not your model. That's a question that I was going to ask, actually. How do you manage that perception sometimes that private capital is that sort of overseas private equity, quick flick around model?
Yes. Well, that's why I'm pleased to do this interview, because I'm proud of all of us in the New Zealand private equity market, because we're all the same. We're all growth investors rather than leverage buyout people. We quite often do. A typical investment for us is something an owner who might be somewhere between 60 and 70, managers who might be in their 40s. The owner wants to sell and sells some of his or her shares to us, and the 3 or 4 managers who are in their 40s come on as shareholders as well. So it becomes a 3-way partnership. It's us as the new investor, the existing management, and the person who used to own the business.
And that's the model. That's one of the models.
That's
anyway.
a really typical structure
typical
for us to invest in.
Okay.
And it's a good one as well, because those companies then become reinvigorated with growth, because it's just to be fair to people, when you're wealthy, when you're 60 and 70, you're still trying to make money, but you've got enough money because you've had a very successful business, and the thrust then comes from the younger investors, the younger managers who think, well, look, we could expand to Christchurch, or we could expand to Australia,
and then they've got skin in the game as well.
They do, and they by and large are very successful, these investments, and one of the things that gives us all pleasure, and you need some kind of purpose to your work, don't you? And that money flows back to superannuitants and to charities, and I just think that's a very nice form of capitalism.
I was going to ask you what makes you tick, what makes you look for these deals. Is it that kind of purpose that makes you tick?
Look, there are a few investors that invest with us that I know we're very important to, and yes, that does give me and all of us here a real sense of pride and a sense of purpose, because you then go and see what they do with the money once you've distributed it back to them.
Wow. So that model that you talked about, has that evolved over 30 years? Has your investment model evolved much, or is it still the same one?
It's we read our investment strategy and our investment criteria when we started in October 1994. It's still exactly the same, with a few minor tweaks. And look, if it didn't work, we'd change it, but it does work.
Wow. Can you tell me, when you're looking for these companies, when you're looking for these investments, how many are you keeping an eye on at any one time? The
private company market in New Zealand is huge. We used to get economic consultancies do work on this, and look, quite some time ago now, the private company market was 7 to 9 times larger than the listed company market. But and we haven't updated that for quite some time. But what we do know is we set a criteria. It's for private operating companies who are profitable and make more than revenues of 35 million plus. And there's 933 of those in New Zealand alone. And we also operate in Australia as well. But that's a huge market.
It's a huge pool to fish in. Not that you're fishing, but to keep your eye on. I mean, 933 companies just in New Zealand that fit that over $35 million sort of criteria.
Yeah.
That keeps you busy.
It does. Look, and I'd like to say there's 20 of us here at Direct Capital. I think we've probably met them all, quite close to probably, I don't know,
You
half
met
of them.
all of the companies? Wow.
I would say so, yes.
So who has Direct Capital been keen on this year? It's done 3 deals, 2 in Australia, a roading maintenance company called Highway, and Bailey's Real Estate, which Direct Capital used to own and Kiwi property watchers will be familiar with. Getting back into Bailey's, can you tell me why you did that?
Yes, quite specifically. Bailey's had been a very successful investment for Direct Capital, and we'd often talked about step change and expansion in that business. Bailey's got an opportunity to buy into McGrath Real Estate in the eastern seaboard of Australia, primarily Brisbane, Sydney, Melbourne.
And for New Zealanders, McGrath, is that a big deal?
It's a very big
seaboard?
deal.
Yeah.
It's big. It's like Bailey's. It's at the very top end of real estate.
Right.
It's it does an enormous number of the the magnificent houses in the cities over there, and it's a huge brand in Australia. And so Bailey's teamed up with Knight Frank, who is their global partner, and McGrath Management, and bought that business. And I think that's going to be a magnificent step for Bailey's going forward. So we invested in a newish company when you think about it.
The third deal done this year needs no introduction.
It's non-caustic, non-acidic and contains no bleach, which means it's totally safe on any exterior surface around your home.
What appealed to you about Wet and Forget?
That's a company we'd known for a long time, a very long time actually, and we'd talked to the owners of that business. It, unbeknownst to a lot of people, it's a very large business in the US.
Hang on, yes, big in the States. So let's pause to hear that iconic name said a little differently.
Wet and Forget Outdoor contains no bleach or phosphates and is non-acidic, so it's safe to use around landscaping and plants.
Okay, who would have figured? Well, Ross George did.
In the US, it was a business and it had its own ownership structure in the US as well, and it's a crowd favourite in New Zealand. Look, even before we became involved, I was a
Wet and Forget convert.
I was indeed, and I know a lot of people are.
Yeah.
And it's got a very known and quite well liked brand we've learned, and I think it's been very good. The growth in the US, once you're established, and this business is established, I think the business is about 70% in the US when we bought it. So it is established in the US, and a market that size has got magnificently, it's magnificently
potential.
Positioned for that growth. Yeah.
Yeah. You've been busy. Is your activity a sign that the overall private capital market is picking up in New Zealand?
I don't think it had a downturn necessarily.
Oh, right.
I think we all just choose. We've got other people's money that we're the guardians of for quite long periods. So we have to have a business where we invest in all climates. Doesn't matter which government's in, doesn't matter whether we're on a raging upswing or quite a deep recession. We still have to have an investment strategy for all of those periods. We didn't invest a great deal in 22 and 23, but that's not because we didn't try. We were just trying to hold firm of what's a real long-term value for a company. And let's be fair, that the stock market did the same. It had a massive roll up, and we've got to just look very long-term. You can't trade these private companies. You're in there for a long term. So the market has changed now. It's become a lot more subdued. In fact, we're really worried about the market in New Zealand.
Really?
Yes. But we're investors, and we often do well investing in these times, because we're going to hold them for 7 to 15 years sort of time frames, and the market will have changed in that period. So is it a buy in the dip philosophy at the moment? It's not. No, it's not. It's not for us. But that's again is a great listed company strategy. Buying in the dips, but. No, ours is very much long-term embedded value type analysis.
Do you have to build a lot of relationships in your business?
Yes, you do, and I'm glad you asked that, because that's the key part of this business. Is you are investing in other people's businesses, and you've always got to remember that, and you're doing it with other people's money. So you've got to be quite respectful, and you've got to know, you've got to know your position in these companies, and we're investing in the ones that we choose and who choose us, because they already are a good company. They're good people with a good strategy and have got the capability to do that. We just come in and help with that. We don't form a strategy for a company. We buy into an existing strategy. So it is an intimate deal that you do have to like each other.
Yeah.
And so we spend in our due diligence periods, we spend a long time in their offices. We make sure everyone from their company knows all of us, because we're a collective group as well, and so you self-select on both sides. They self-select us because they like us and respect us, and vice versa.
It's a bit like a dating game, really,
with
a lot of ramifications.
Do you know what? I think it's more than that. I think it's a marriage game, because you do end up being intricately involved in their businesses, it's got some nice components to it. We often find ourselves going to their children's weddings and 21st and things like that. So it is that sort of business.
And you have seen a lot of that over 30 years, I would imagine.
We
with
have.
The companies that you've been involved in, and the people behind them, the people that founded them, the people that have been running them.
We've invested in 84 companies over our time,
and a lot of them really high-profile, well-known New Zealand companies. Yeah. But I wonder whether New Zealand is still a bit small for you and for private capital. I mean, how important is it for you when you're looking at a company, like you mentioned with Wet and Forget, that they've got that overseas potential, probably Australia, if not somewhere else?
Yes. Look. Some companies can survive with good growth in New Zealand. Lots of them. It's quite interesting, is that New Zealand and Australia are quite pegged to each other, aren't they? In reality, our people are there and their people are here, and it's an easy, wealthy market for us because it's close to us. We've got a magnificent trade deal with them, and they with us. And one reason is, I don't know if you've ever read that agreement, but it's short, and it's very easy to understand. And so everyone knows how to move to Australia, how to export to Australia. But I think one thing we have trademarked ourselves is a lot of our companies, if they weren't Trans-Tasman when we invested, they became Trans-Tasman. And Australia's been an incredibly kind market to us. I've always rankled at the saying that New Zealand companies can't do well in Australia. We can, and in the private company market, it's overwhelmingly good.
Right. We like those Aussies then.
We do. Look, we do, and they like us. There's a sporting rivalry, and there's pockets that don't like each other, but that's every country. We get on very well with Aussie. Yeah.
So what does New Zealand need in terms of investment going forward, do you think? When you step back and have a look at the private capital market, or even the public market, what do you think New Zealand needs?
I think first of all, people can find a way to invest, no matter whether there's doors open or doors shut. There's ways to get engaged in it. But I must say, we've had an example. You need a government for the investment markets, and look, the energy market has, There's a given in business, and that you will have available energy at a predictable-ish sort of price.
Yep.
And for industry, energy is a very, if you're cooling or heating or mechanically pushing things together or grinding them apart, that is a very large energy user. Now, no company can succeed if you've got an energy market like that.
Right.
And look, the government, I hope the government knows it, and I hope they know that it's a very urgent issue, because we can handle any business issue thrown at us, but we want the scaffolding up, and we want we want infrastructure up and to be user friendly to business. People were just outrageously dismayed at what happened in the energy market, and that's probably the, there's lots of geopolitical things out there that we should be scared of, but that on its own will become part of the decision to invest in New Zealand or not from offshore. Does it have a workforce? Yes, it does. Are they educated? Yes, they are. Is there rule of law? Yes, there are. Is there reliable infrastructure? Energy gets the cross, and we must deal with that really urgently if we want foreign capital, and particularly, as I say, in the heavy industrial market.
Have you noticed that offshore investors are pointing that out to you?
Yes, the Aussies are.
The Aussies are.
Yes, yeah, because Aussies blessed with energy, aren't they? And yes, look, I haven't sought that kind of information. I know that's what the Europeans are sceptical of us already. But I just think you just have to be careful that you've got the. I don't know why I use the word scaffolding, but
it's the building blocks that you need to shore up business.
I think we have to say, the analogy I would use is, government, you build the roads, we will run the trucking business that uses the roads, and we'll deal with all of the trucking issues, and we want you to deal with all of the roading issues, and energy is a roading issue.
If I could just get you to look back again, I know we started that way, but just wondering, if you do look back, can you categorise your biggest success? Can you identify that? Or is it the overall business?
I know you were asking for a company. I'll tell you the biggest success is that we have learnt to work really well with private company owners, and we've kept the confidence of our investors. So we've had a flow of capital, and we've had a flow of companies that we can get on with. But I know your question is which one is visibly. Ryman was probably the best company we had. We invested in it at a value of 28 million. It went to 6 or 7 billion, I know, but it's still a $3 billion market cap company, and it provides a magnificent service to elderly people.
You invested at 28 million?
Yes.
And it's now worth 3 billion, even though it went up to 6 billion. What was it worth when you got out? Can you tell me?
Yes, I can, but as it turns out, parts of direct capital stayed in there for a very long time.
Right.
So, but the answer to your question was 180 million.
Wow. Do you have a biggest miss? Is there one company that got away?
There's an industry that got away.
What's that?
Look, we were very close to a lot of quarries over the time, and they would have been great long-term investments for us. We don't have a quarry investment, and yet we've done a lot of work on them. Look, I think you always have misses in this, things that we should have or could have, and there are always those things. But we are very much risk-driven. Like all of these companies are opportunities. Sometimes we look at a business, we identify a risk, and then we try and work out what the probability of that risk happening and what can you do if it does happen. And some of the businesses that we consider to be a miss had all of those characteristics. It's just that risk issue didn't come up, and it was a magnificent, it didn't eventuate, and it was a magnificent investment. So, but look, I'm in an analogy mode at the moment, but we often say, we're like playing a 50 over match, a 50 over cricket game, and if you score 7 or 8 and over, you'll probably win most games. And so you don't need overs with 24 or 26, and you don't need overs where you lose 3 wickets. So we're just trying to be very consistent in the way we generate capital profits and income.
Okay, as you said, you're about to raise or in the middle of raising another investment fund, your 7th.
Mm-hmm.
And I wonder, just in terms of your activity, like scheduling this interview's been a little bit all over the place. I just wonder whether there's a big deal going on at the moment.
There is.
There is?
There is, and I apologise for that. But yes, look, this is a business that's like we're always on as the first thing. Whether when you're in the supermarket, you're looking at brands that are in there. When you're in a tyre place getting your tyre changed, you're looking at the company that's doing it. And there is one on at the moment, and we are very busy. And when there is something going on in one of our companies or making a new investment, it is very full on. And I don't know if you saw next door, there's 20 seats there. There's probably only about 5 people here because the others are all in that company. Yeah.
Right. You don't want to share, obviously, who that could be.
No,
and that's because it's called private capital.
Actually, I'll tell you, when you said what are your great achievements, one of them is we've become very good at confidentiality. You know, we often walk into a room and we know sort of 4 or 5 different situations there, and you just simply can't mention it, and you don't. We have this information dissemination policy called nothing, nowhere, never.
The Godfather never tells. And that wraps up this Dealmakers episode of the NBR Podcast. Check out the full Dealmakers series with more than a dozen stories throughout the week at nbr.co.nz. All audio links used in this episode are in the description, thanks to content producer Joseph Hisayasu and creative director Michael Hickmott. Next up, we road test the government's new chatbot, GovGPT. I'm Simon Shepherd. We'll catch you then.